Well, joining us for further analysis is Chinwe Egwim, Chief Economist, Coronation Merchant Bank, joining me via Zoom. Great to have you on the show.
Thanks for having me.
So first off, let me get your take on the Q1 GDP data. It's lower than Q4, definitely. Is that the effect of the 600 basis points interest rate hike we saw? And what's it telling us, basically? Is it aligning with your growth outlook for the first quarter?
Okay, thanks for that. GDP grew by 2.98%, as you said. I had actually expected a more sluggish growth number, let's say at best 2.3%. And this was largely on the back of the expectations around the usual post-festive slump when compared with the final quarter of each year, which is, of course, synonymous to festivities, right? In Q1, inflationary pressures did persist, with prices of food items escalating, and this, by extension, weighed heavy on consumer pockets. Of course, that's in addition to other factors that did contribute to squeezing pockets and purses. But I think it's worth highlighting that on a quarterly basis, the GDP contracted by a significant figure, which was minus 16%. So this positive growth that was registered in the year-on-year basis may very well be due to positive base effects, but the economic realities, what we're facing or what we're seeing, were indeed reflected in the data release from a quarterly perspective. Now, to your point around the monetary policy rate hikes, about 600 basis points in the first quarter of this year, especially those recorded in February and March, they were aimed, of course, at stabilizing the naira and controlling inflation, but of course did have mixed implications. An adverse effect is that rate hikes make borrowing costs more expensive for SMEs, which rely on loans for growth. Yes, it is true that the SME community within Nigeria has operated in a high interest environment for years, and some have found ways to cope, but just based on anecdotal evidence, the recent elevated levels of borrowing costs is impacting growth and expansion activities for SMEs. And why is this really important? SMEs account for at least 50% of the national output. And the domino effect of this can be seen in higher costs of goods and services in general as businesses pass on their increased borrowing costs to consumers. So bringing all these home to your question, I would say that, again, SMEs do account for about 50% of total GDP. Therefore, there is a strong interlinkage with the dynamics within the SME space and national output figures.
Right, and you did mention it came in stronger than your outlook. That's the first quarter GDP number there. But do we have to be worried about this month-to-month massive drop we saw from the fourth quarter of 2023 into 2024?
I would say that in Q2, April to be specific, we're still in Q2 by the way, but April to be specific, we did see a short-lived appreciation of the naira against the USD. I think we saw it at 1,100 naira per USD after hitting 1,600 in March, and that is in the NAFEM window. So far, we have seen a swing from appreciations to depreciations, which is the natural interplay between demand and supply in a free-functioning market. And that said, our current projection points towards another positive growth on a year-on-year basis. And then my personal opinion is that on a quarterly basis, it would slightly be better, but another contraction, perhaps slower.
All right, let's look at these sectors now. Which one stood out for you in the GDP report? We're seeing quite a big jump for that's the minerals and ores there. How's that looking for you?
I think I'll just highlight two sectors. Well, the oil sector surprised me again. It grew by about 5.7% in the first quarter. And that is the second consecutive quarterly growth that has been registered. And I guess the recorded growth can be partly hinged on relatively better production levels. Additional insights suggest that the improved performance is due to substantial investments operational enhancements, and conflict resolutions among stakeholders, and I guess the reactivation of inactive oil assets. I think what we understand is that the FGN's efforts so far have renewed investor confidence to an extent, resulting in significant commitments, including the $5 billion and a $10 billion in offshore assets, and I think a $1.6 billion in asset acquisition. So that's interesting, and I guess it's a sector that we all should keep our eyes on, given its importance to government revenue. I think the second sector, which surprised me, is agriculture, but not in a positive way. The growth figure for agriculture was unhealthy. It came in at just 0.2% compared with 2.1% in the previous quarter. For a sector that accounts for over 20% of total GDP, this sector should be performing way better. And I hope that we get to see policies that support a boost in productivity within that sector in the near to medium term.
And looking at, the Q1 data, at this time, everyone's trying to find out or trying to project when inflation is going to peak in Nigeria. But I want to get your general outlook for the economy in 2024, that's the Nigerian economy. Are you expecting a hard landing, a no landing, or some kind of soft landing?
Well, I guess it depends on the indicator I'm talking about. So if I should touch upon inflation, which you just mentioned, I actually at this point see it peaking between June, July, and then we'll see very tiny dips. And those dips, again, are really on the back of positive base effects. At the end of the year, right now, again, understand that these projections are always revised, but right now our current projection does show that inflation will remain above 30%. Towards the end of the year. But I see it peaking and then just registering very tiny dips.
And with this data, what do you think should be the plan of action, for the federal government and the CBN, at this time, and a quick outlook for the second quarter of 2024?
I would say that regarding the CBN MPC, I guess that's what you're asking when you say CBN. The MPC's primary mandate is to ensure price stability, right, through the strategic deployment of monetary policy tools. I expect that the committee will maintain its inflation targeting posture, but just to combat rising inflation, which has a trickle-down effect on even GDP figures, right? In addition to monetary policy, effective fiscal policies are required to support efforts from the monetary policy side, such as fiscal tools that can help with easing supply-side constraints, mitigate inflationary pressures, as well as implementing structural reforms to address infrastructure deficits, enhance agricultural productivity, and improve just the business environment in general. All these can boost supply capacity, therefore dampening inflationary forces. But these fiscal support measures that I've just mentioned, and please understand that there's so many more, I'm just listing as much as I can given the time constraints, but these that I've just mentioned are more medium to long term in terms of the economy feeling the impact.
All right, Chinwe, before I let you go, I'm going to put you on the spot a little bit. Right now, it's Children's Day, and happy Children's Day. And definitely, we know that times are really tough right now. What should we be teaching our kids, to navigate this tough world we're seeing right now, and what to expect in the future?
Oh, wow. I think that there's so many things to teach kids, but off the top of my head, I would say financial literacy can never be overemphasized. So using the right tools, books, classroom activities to teach kids on how to, understand financial literacy. Inflation is a good subject or topic to hone into in a manner that they would understand. So I guess my nutshell answer would be financial literacy. There's so many other things, but yeah.
Financial literacy. Well, I wish my parents taught me that while growing up. Thank you so much. It was great having you, Chinwe Egwim, Chief Economist, Coronation Merchant Bank. Thank you so much.
Thanks.
All right, we'll take a break now. When we come back, head straight to the markets. Do stay with us.